All right, today we are getting right into the technical weeds of retirement accounts. We're going to do a deep dive, a real breakdown of the specific IRS rules for getting your money out, both when you want to take it early and when you absolutely have to. We'll be covering everything from the famous Rule of 55 to the brand new rules from the latest laws, and of course, the mandatory withdrawals we all know as RMDs. This isn't a high-level overview. We're looking at the exact codes and court cases that define these rules.
So here's our game plan. We'll kick things off with the foundation, that baseline 10% tax. Then we'll explore the ways you can get around it, like the Rule of 55 and something called SEPPs. After that, we'll get into the huge changes from the Secure 2.0 Act, then completely switch gears to required minimum distributions. And finally, we'll pull it all together so you can see how these different strategies stack up. Okay, let's dive right in. Look, before we can even begin to talk about the exceptions, we first have to master the rule itself. And that rule is the 10% additional tax on early withdrawals, which comes to us straight from the Internal Revenue Code, Section 72T. This right here, this is the number that starts every single conversation about touching your 401k or IRA before you hit age 59 and a half. Section 72T slaps a 10% additional tax on the taxable portion of almost any early withdrawal. You can think of it as the main barrier the government put in place to keep retirement money saved for, retirement. Now, here's a really important technical point. Everybody, and I mean everybody, calls this a 10% penalty, but the tax code is very specific. It's an additional tax. And this isn't just about semantics. It literally changes how it gets reported. We're talking Form 5329 specifically, and it has real implications for how underpayments and interest are calculated. For any tax professional, that distinction is absolutely crucial.
So that brings us to the most famous exception of them all, the Rule of 55. It sounds so simple, right? But as we're about to see, that simple name hides some major and very easy to misunderstand complexities.
And here it is in all its formal glory, direct from IRS Section 72 T22AV. Let's break down the key ingredients here. 1. You have to separate from service. That's just IRS speak for you leave your job. 2. It only applies to the plan of the employer you are leaving at that moment. And 3, the timing. The timing of when you leave relative to your 55th birthday is everything. This brings us to the number one point of confusion with this rule. Do you actually have to wait for the candles on the cake? Do you need to be 55 on the exact day you walk out the door to qualify? Well, the answer comes straight from the horse's mouth. IRS Notice 8713. And the magic words are right here. During or after the calendar year. That phrase changes everything. It's not about your birthday, it's about the calendar year you turn 55.
Let's make this really concrete, because this is where the power of this rule kicks in. Imagine someone whose 55th birthday isn't until the very last day of the year, December 31st. Well, they could actually leave their job way back on January 2nd of that same year, while they're still 54 years old, and they would still qualify for penalty-free access to that 401k. It all works because the separation happened in the calendar year they turned 55.
Okay, listen up, because this is probably the most important point and the biggest trap you can fall into. The Rule of 55 is not portable. Let me say that again. It is not portable. This amazing exception lives and dies with the specific 401k of the employer you just left. The second you roll that money into an IRA, poof, the protection is gone. And this isn't theoretical. We saw it happen in the tax court case Caterino of a commissioner. A taxpayer made this exact mistake, and the court made them pay the 10% tax. It's a costly error.
And if that wasn't enough, here's another huge layer of complexity. Just because the IRS says something is okay, doesn't mean your 401k plan has to allow it. The tax code permits Rule of 55 withdrawals, but it doesn't force your employer to offer them. The ultimate authority is your plan document. And if your plan, for example, only allows you to take a single lump sum payout, you could be forced to take your entire balance at once, creating a monster tax bill, even without that 10% tax on top.
All right, let's move on to the next major exception. This is often the plan B when the Rule of 55 just doesn't work for you. We're talking about substantially equal periodic payments, or SEPPs for short. Now, this method is way more rigid, but its big advantage is that it can be applied to IRAs and you can start at any age.
Now, to use this strategy and avoid that 10% tax, you can't just pick a number out of thin air. You have to use one of three very specific IRS-approved calculation methods. As you can see from Notice 2022-6, they are the RMD method, the amortization method, and the annuitization method. Don't get too hung up on the names. They're each just a different formula for turning your lump sum into a steady, predictable income stream.
But here is the biggest, and I mean biggest, catch with SEPPs. Their total lack of flexibility. Once you turn on that income stream, you are locked in. You are required to continue taking those payments for whichever is longer, 5 full years or until you hit age 59 and a half. If you break that rule, if you take too much, too little, or just stop, the 10% tax comes roaring back and gets applied retroactively to every single distribution you've ever taken plus interest. The stakes are incredibly high. You know, the world of retirement planning never stands still, and the recent Secure 2.0 Act completely shook things up, adding a whole new slate of exceptions to that 10% tax. This has created new ways to get to your money in very specific situations. One of the most significant new exceptions is for terminal illness, and it's really important to see how different this is from the old disability exception. See, the disability rule has always been about your ability to work. This new rule from Section 72T2L has nothing to do with that. It is based purely on a doctor's prognosis. If a physician certifies that a person has a life expectancy of 84 months or less, their retirement funds can be accessed without that 10% tax, regardless of whether they're still working or not. And Secure 2.0 didn't stop there. It also gave a boost to public safety employees, expanding their rules so they can get access as early as age 50 or after 25 years on the job. Plus, it created several brand new exceptions for very specific situations, like a small amount for emergency expenses, some relief for victims of domestic abuse, and aid for those impacted by major disasters.
Okay, so far, everything we've talked about has been focused on the rules for taking money out early. But the IRS is also really concerned with you not taking it out. And that brings us to the other side of the retirement coin, the rules for when you must start withdrawals, which we all know as required minimum distributions, or RMDs. Now, a really powerful strategy for pushing off RMDs is the still working exception, which you can find in Section 401A9C. The idea is simple. If you're still working past your RMD age, you can delay taking RMDs from that specific employer's plan. But you've got to watch the limitations here. It doesn't work if you own 5% or more of the company. And critically, it does absolutely nothing to stop the RMD clock on your IRAs or any of your old 401ks from previous jobs. The RMD age itself has really been a moving target lately. For decades, it was stuck at 70.5. Then the first Secure Act came along and bumped it to 72. Now Secure 2.0 has pushed it again to 73, and it's scheduled to go all the way up to 75 in the year 2033. Each one of these increases gives your money more precious time to grow tax-deferred. For years, the penalty for messing up an RMD was one of the scariest in the entire tax code, a brutal 50% excise tax. Well, Secure 2.0 brought some massive relief. The new general rule cuts that penalty in half, down to 25%. And even better, if you catch your mistake and fix it quickly, that penalty can drop all the way down to just 10%. This is a huge, huge relief for taxpayers who just make an honest mistake. All right, we have covered a ton of technical ground, so now let's zoom out and pull all these pieces together into a comparative framework that can really help guide some strategic decisions. This chart right here really serves as the ultimate cheat sheet. Just look at it. You see that big, beautiful yes for the rule of 55 under 401ks, and then the big, scary no for IRAs? That's the IRA trap we talked about, right there in black and white. Now, contrast that with SEPPs and the new terminal illness exception. Notice they get a yes all the way across the board. And the still working RMD deferral? That's another 401k only perk. This makes it crystal clear. Where your money is sitting matters just as much as your age or your life situation. And this all brings us to the final and most critical question of all. The tax code provides this complex, fascinating framework of options and exceptions. But here's the thing. The code is not the final word. The ultimate authority, the document that truly matters, is your specific plan document. So before you make a single move based on anything we've discussed, you absolutely have to ask, what does my plan allow? Because in the world of retirement accounts, the law might open the door, but it's your plan document that actually holds the key.